Thank you, Miss Petra, for joining us to talk about some credit. Uh, Miss Petra-Ann from Brown Financial Solutions. We're going to talk about credit and how we can, as it says in your presentation, increase our buying and borrowing power. So I'm just going to turn the virtual mic over to you.
Thanks, Ray. Thank you so much for that warm introduction, right? Good afternoon, everyone. My name is Petra-Ann Brown. I am the founder of Brown Financial Solutions and the host of the Island Money 365 podcast. At Brown Financial Solutions, we help individuals rewrite their financial stories by providing them with the tools, the confidence, the clarity to build healthier money habits. In today's workshop, we are going to talk about, and if it can get it to move a little bit, here we go. There we go. Today's workshop, we're going to talk about your credit blueprints, what it is, how it works, and how to improve it. I must say, there's a lot of energy when it comes to raising our credit score or paying down debt. But debt and credit score is not the only part, right? It's not the only part of the pie that we should be focusing on our journey to financial wholeness. It's only a little portion of it. And while it might seem like a big deal, which I'm not saying it's not, we need to look at the whole picture and not its parts alone. So being debt free and fixing our credit is a goal. And I like to tell my clients that whenever I do a presentation, I just say, it's a goal. It is not the goal. The main purpose of fixing these things is to rewrite our financial story, put ourselves in a better position, financial position, and to have excess money to go towards growing wealth, which is, I hope for you, is the ultimate goal, right? Because after that, right, we want to get out of that. What's next? What is next? So my goal for you for this workshop is for you to understand what is credit, how credit works, the different components of credit, and the role that debt plays. Why do I want that for you? Because success is not possible unless you understand the rules of the game you are playing. So, for me, I always think about my oldest son when he was 5, he played, I was signing up for the little town basketball through the community center. Of course, it's a bunch of 5-year-olds. They know nothing about the game, and they had one practice a week, and then they had games on Saturdays. So they come to practice and they'll take up the ball. The coach had to teach them how to dribble, how to pass, or at least the concept of it, right? And most of the times they're taking up the ball, they dribble once, and they then pick it up and run. Um, and during the games, no, the refs were great because they know these are little kids. They would dribble, try to shoot, and the refs would be like, they didn't call anything. So even though it was cute to us parents, we were smiling, we were laughing, the kids were playing their hearts out. It was a hot mess. It was just simple a mess. Why? Because they did not understand the rules of the game. So I do not want your credit to be a mess. And it is, and if it is, I want you to understand the rules so you can clean it up and put yourself in a position to win. So, what do we need for this workshop? For this workshop to be informative, for this workshop to work and to provide the information that you need, I need you to have an open mind to receive the information, right? And I don't want you to be honest and willing to be honest about your money situation to yourself. You don't have to share that with me, but at least to yourself and say, you know what, I need to work on this. Pen and paper to write things down, right? And a quiet place if you can, or at least to be engaged with this workshop. So if you can want to take yourself off mute or you want to talk in the chat, I am open. I'm here to answer any question you have. This workshop is for you. And if you want to go in a different direction because you have a different question than what I have prepared, I am willing to go there with you because I want to give you that information that you need. So come back to me if you're distracted or anything like that and be ready to get started and be informed, right? All right. So, as I said before, but I really want to hit it home, being debt free and fixing your credit is a goal. It is not the goal, right? Because Once you fix your credit, once you're debt free, what's next for you? So hopefully on your path to financial wholeness, on your path to financial freedom, or having the life that you want, you have a bigger picture in mind, and you're just trying to fix this part so you can tighten up everything so you can get there and be on solid financial ground. Now, we cannot talk about credit without talking about debt, without talking about spending, and we cannot make a plan on how to better our credit or pay down debt without understanding our money. We can't, right? All that have to do with us understanding what's coming in and what's going out. So this is not a budget workshop. No, we do have those, and I'm sure I've done one of those for Headco in the past, and probably we do them annually. But even so, you can look in the resource center. I believe you can find the workshop there. But for anything to take place, you have to know what you're working with, and that's a budget. So let's go over it very quickly, not in depth here. You need to understand what is coming in, which is your income, right? We call it money in, your income, your paycheck, your child support, your side hustle, your alimony, your social security, anything that is coming in, that is considered your income. And we're going to talk about the money going out. Money leaving you, never to return again. We're talking about your utility bills, your groceries, your gas, your kids, your kids. Let's repeat that, your kids, your mortgage, your rent, your bus pass, cell phone bill, anything that's going out, all your expenses, right? I want you to add up. I get a total summary of your income and then get a total summary of your expenses. Usually, in the budget workshop, we break down the expenses into fixed and variable and different categories. But as I said today, we're just going to keep it at its simplest form. So we're going to subtract, after you get a total for both the income and the expense, you're going to subtract your expense from your income. And that will give you your beginning monthly savings. And I hope you see the words that I put there. Your beginning monthly savings. That's the money you're going to start working with. That's your starting point. That's your launching pad as we go further on to taking care of your finances. If there's nothing there, look at your expenses. See what you can get rid of. See what's need versus wants. Or maybe it's not an expense problem, maybe it's an income problem. Figure out what you can do to bring more money so you can have money here. Well, for this workshop, we're going to assume that you have some money left over here. And we are going to take that number and start our journey at least towards, building up, paying off our debt, building up our savings, and fixing our credit. So my first question for you, as we begin to talk about that and dive into that, is debt versus available credit. When someone refers to that, what are they saying? What are they thinking? Does anyone know? Debt versus available credit. What does it refer to? Okay, and let's see what's in the chat. Okay, if you pick B, the answer is correct. Let me read that before I actually, the amount of debt you owe. Yes, B, the amount of debt you owe creditors versus the available credit. So when you're talking about your debt versus available credit, you're talking about what do you owe to your creditors and then what's available for you to still use, right? Debt. Hope you can see my screen very well. I have this little thing here. I have to move. There you go. Okay, so let's dive into. Now that we know, if we go back to the budget conversation, budget slide, and that number after you subtract your expense from your income, now that we know what we're working with, let's talk about debt. First, we have to change our language when it comes to debt. A lot of us say, "Oh, I'm in debt," right? And I was reading a book. I read this book a few years ago, and it says we need to change our language when it comes to debt. Debt is not a place, it's not a location. We cannot Google map and find you and pick you up in debt, right? So you owe someone debt. You owe money to someone, I should say. You owe money to someone. You're not in debt. So we have to be careful of the language we are using. And my mom always tell me, be careful what you say. Words have power. So you don't want to use language that keep you stuck in a situation or in a place. You want to use transformative language, especially when it comes to our finances. So I also want to mention, so we work on our language. Next thing we need to do is understand that being debt free and being wealthy are not the same thing. It is not. So once again, a lot of focus on being debt free. As I said, my story was I was $68,000 in debt, and when I discovered that, I was hyper focused, and it took me 15 months to pay off $68,000. And people was wondering, how is that possible? First of all, bare minimum. Absolutely. I over sacrificed, but that was my choice. And I didn't have children. It was just my husband and I. And I was willing, I wanted out of this situation. So I over sacrificed, and I did it. I mean, peanut butter and bread, or just some ramen noodles, like back in college. I had a ramen noodle budget. Okay. There was no room for anything else. But after that, after we were debt free, and I put back at least $1,500 back in my budget. So that's how much money was leaving me every month, 1,500 to $2,000 a month. Think about that, right? On debt and paying creditors for student loans, car notes, personal loans, credit cards, putting that back in my budget. I'm like, okay, what's next? I didn't think beyond getting out of debt, right? I just knew I wanted my money back, because debt robs you of your income. It robs you of your paycheck. So once I got that money back, now I got to think about, oh, we got to start building wealth. Oh, what kind of tools we're going to use? So that's why I keep reinforcing that to you. Understand that being debt free is only the first step, right? Being wealthy, that's hopefully after you get out of debt, you're going to start working towards that process. So being debt free and being wealthy, not the same thing. Focus on the big picture, put energy into building wealth, not being debt free and building credit alone. That's only part of it. So, um, being debt free, free up your money so you can begin to build wealth. Once again, as I said before, put your energy into building that wealth. So, what do you need to do to get on this journey, to get on this path of financial wholeness, financial peace, or to build a life that you see yourself after the credit and after that? We need to get a piece of paper and pen out, and let's talk about the debt portion of it. Identify your debt. You need to restructure your debt. Choose a pay down plan or a payment plan, and automate the pay down plan. This is how you're going to dig yourself out. These 4 actions are needed. So the first one we're going to tackle is identify your debt. Now, when you're identifying your debt, this doesn't mean go in your bank account or just look at your credit report. I really want you to take some time, take a moment, your quiet space, sit down with your pen and paper. Don't use any fancy apps. Don't do any of that stuff. Just pen and paper. Keep it simple. And I want you to make a little spreadsheet or make columns on a paper and name the debt. List the name of the debt. If you owe your grandma, if you owe your auntie, if you owe your uncle or your mom, their name should be there too. You need to pay them back. Because they're family doesn't mean they cannot pay, you should not pay them back or take advantage of them. Okay. So list the name of the debt, the person or the company, the total amount owed. Now, I am not talking about the original amount, but I'm talking about the balance that is owed. Right? Then we're going to talk about the minimum payment that is due. The minimum payment due, meaning that this is the amount you have to pay to not pay late fees, right? For there not to be a late charge. Also, you need to put the interest that's being charged on that debt, and then you need to put the due date. Quick tip that I think most people don't realize about the due date. The due date is time zone specific. A lot of people don't realize this. And when I say this in presentation, they're like, what? The due date is time zone specific, meaning that the due date is based on the time zone of the creditor. So say I live in let's say Central Time, or no, Pacific Time. And then your creditor is in Eastern Time. Because I think Pacific Time is behind me. Whichever one is behind, I get confused between Central and Pacific sometimes. That's why I have Google. But say that an Eastern Time, and the creditor is in Eastern Time, and is 1 hour ahead or 1 hour behind. Remember, so if you decide to pay at midnight for that day, say, oh, I'm getting on time, but your creditor time zone have midnight ahead of you, guess what? You're going to be late. You're going to be considered late. So let me clean that up a little bit. Your creditor, am I on again? I see myself on again. My creditor, your creditor time zone is a time zone of the payment due date. So if your creditor is an hour ahead and you pay on your time zone, you're going to be late, or how you're going to be late. Does that make sense? I hope that makes sense to you. Okay. So also, not only that, some creditors, their due date or the cutoff time is time specific as well. And I was surprised when I read that and I saw a big article about that. I saw them time you have to pay by 5 p.m. because some of them got to pay by midnight. So it's not always a full day either. So that's something you should keep in mind as you are paying your bills. So if you could pay the day ahead of time, that would clean up or prevent you from being late. Of course, you can always call and say, hey, you know, I did not mean to be late. I paid on time, but obviously there was a mix up. And when they explain to you, so going forward, they can waive it one time, but they're not going to waive it every time. So be mindful of that. Next thing is the statement closing date. The statement closing date is the last day of your billing cycle. It's the day your bill is generated. It's a very important date, and you need to know when that is. Typically occurs about 21 days before your payment is due. You really need to know this date. It's usually on the statement. If it's not there, call your creditor and find out when that closing date is. Right? Because that statement date is when your monthly interest charge and minimum payment are calculated, right? Hence the bill. Then when the bill is generated. The information generated on this day is what gets sent to the credit bureau. So you need to know this day is a very important date, especially if you're trying to fix your credit. Are we talking about utilization rate, which we're going to talk about later in the presentation? This is a very important date for you to understand. Right? The next thing we need to know is the status, which I don't see up here, but the next thing we need to know is the status. Is it in good standing? Are you behind? Are you current? Are you late? You need to know that information. So when you have put all that information on a spreadsheet or on a piece of paper, you can look at your information and see what's going on and make more informed decision. You can see which one have high interest rate, which some of us don't even know the interest rate on our card anymore, or we have variable cards. Some of us not fixed interest rate, and it goes all over the place, and you're very surprised of what's taking place with that. Next thing we got to think about, a part of that is the restructuring your debt. Now, some of us have a credit card debt, right? First thing we can do, we can try to negotiate a lower interest rate. It might work, it might not. It doesn't matter. We have to try, especially if a very high interest rate and say you're a very good payer, like you pay your bill on time. Try to negotiate a lower interest rate. If you have a variable rate, see if you can get a fixed one. You never know unless you ask. I have a pop-up here. You never know unless you ask. Another thing you can do, some people play the transfer balance game. This is a very risky game. It's not something I advocate for, but it's something that you must be very informed if you're going to play this game. Or let's not call it a game, but I know some people that just keep transferring. But there are information that you need to know. First, if you're going to transfer your credit card balance to a zero interest credit card, make sure that they do not charge you a transfer fee, right? If there's not too many of those out right now. Usually in the past, you could get a zero transfer fee and they transfer your balance. Now you're seeing fees between 3 to 5%. You see fees being charged to transfer your balance. Now, another thing that you need to think about when you're transferring balance on these 0% interest card, you need to think about, okay, am I going to be able to transfer the full amount? So once you got approved, right, are you able to transfer a full amount or only part of it? And is it worth it? You need to do the numbers yourself. So if you look at it and say, okay, they're charging me 3%, and they say, if I transfer the transfer fee will be $300, but my balance is $10,000. it might be worth it because paying interest at a high interest rate for $10,000 for a year, it might be like a couple thousand or significantly higher than that balance transfer fee. So do the math and see if it works for you. Another thing you got to think about: how long is this rate good for? 3 months, 6 months, a year. So if you're going to transfer it and it's only for 3 months, are you going to be able to pay off that balance in 3 months? Because if not, guess what could happen? Now you're going to have to pay interest on the balance that's transferred on the past, and then now what's going forward. So it can be a double whammy and even put you further into that. So you need to be well informed if you're going to do this as one of your way to restructuring your debt. The mortgage debt you're looking at, you're talking about refinancing. Talking about refinancing here, is it worth it? The closing costs, the all the fees that are associated with, or is it just better to just, pay down your mortgage and put extra money on that mortgage monthly to seek to bring down that principal a lot faster than normal. Other one is student loans. That's another debt. And when I say restructuring debt, I'm not saying these are the only debts that are available, but these are the most common debt. That's why I put these on here: credit card, and mortgage, and the student loans. Those are usually the most common debts, and they what most people have, well, big ticket items that most people credit report, right? So student loans, most rates, I should tell you, student loans rates are fixed, federal student loans. So do not refinance. You cannot refinance student federal loans, not the private ones, the federal loans. Why? Because that rate is fixed by Congress, right? So they can't just change it up like that. Congress set those rates. So if you're going to refinance, you're going to refinance out to a private loan, and you don't want to do that because the federal loan have more options for you and it's more forgiving, meaning that they have forbearance program, they have their deferred program. The private market is not as flexible or understanding when it comes to the student loan. So I will stay in the federal program, and they will work with you, and they have a lot of programs they are available for you for your situation. Still might not be fun, but you have a lot more options. And things are changing, I know, with the big beautiful bill, and we haven't seen all that's coming down the pipeline yet with that. But for now, you have a lot of it's a better option for you. So do not refinance out of the federal student loans. If you have federal student loans, call them, see what option you have to, how they will work with you based on your situation, and so we can go from there. Now, when we're talking about debt, we have to think about how we're going to pay off our debt. Now that we understand and we broke down the different areas and how to restructure and how to pay it back, we got to think about what decision you're going to make, or what way we're going to pay back this debt. Are we going to use the snowball or the avalanche? And there's other ways you can do consolidation, but the two ways I'm going to talk about today is the debt snowball and the avalanche method. Now, the debt snowball, as you can see here, is you list your debt in order. You list debt in order by balance. So it goes from you're going to pay off the smallest and then go up way to the biggest, or to the largest, proper grammar, to the largest. So you're going to make the minimum payments on all the accounts and pay extra towards the one with the smallest balance. So that money that you have left over that you're working with from your budget, from that money, that little pile of money that you have left, or a big pile of money that you have left, take some of that money, put towards saving, and take the rest and put towards paying down debt. And as you pay down the smallest debt, you realize that the money you pay towards your debt is increasing as you go from paying off your smaller debt to your large debt. It accelerates the rate at which you can pay down your debt. So it goes much faster. It gives you little wins. It give you like a victory, which is great. I love little wins. I did the debt snowball when I was paying off my debt, and it just kept me motivated and kept me going, because as I pay off, and I was like, yeah, I can do this. I can do this. Let's go. And it gets harder, of course, as you get to the bigger debt, but those small wins keep you motivated. And who doesn't need motivation? Right? We all need motivation, little good job on a little pat on our back as we go forward and building and paying down our debts. The avalanche method is that, once again, you list your debt in order. You can list smallest to largest or largest to small. And then you're gonna pay off the bigger debt first. The one with the highest interest, I should say, more specifically, first. Now, this can take a long time. This can be a uphill battle, but if you're disciplined enough, it is doable, and you save money in the end in terms of on interest because you're attacking the higher interest one first. You can do a combination of both. Whichever method you prefer, the things I just want you to start. Next, the way we can, after we start paying down our debt, there are different ways we can boost the debt payment process. For example, we're in the holiday season, right? We get birthday gifts. Hopefully some of us still get birthday money. It was my birthday yesterday, and I got a little money yesterday in my envelope. I was surprised. Usually I don't get any money, so I got a little money yesterday. So you can use that unexpected money to boost your repayment by putting it towards your debt or building up your emergency fund. I want to tell you this: debt free plus no savings equal having debt. It really does. Why do I say that? What do I mean by that? Because if you're working to get debt free but you have no savings, life is still happening while you're going through this transition, while you're going through this process. Life is still happening, and financial winter. Why's my hand up? Hold on. I see something here. Hmm. I don't know. My hand is up, but I don't know why. But okay, let's keep going. Okay. So, as I was saying, and financial, you're still gonna have your financial winter. So you want to make sure that you're in a position that as you're paying down your debt, if life happens to you, like say something unexpected, like a medical bill, or some kind of expense or family health or something like that comes up, or something that needs to get fixed on your car, you didn't expect it because your car is practically brand new, but guess what? Something happened. You got a flat tire or something, or the brakes go, you have some money to cover that. You're not going back in debt to cover those expenses, unexpected expenses. So we really need to, while we're paying down debt, also build up our savings account or emergency fund so that we can keep ourselves out of debt or have that cushion we need in case life happens. Next thing I want you to do is to automate your pay down plan. But I don't want you to automate by giving the institution access to your money. I want you to set it up that your bank pays the money. So you want to come in and take out the money because sometimes what can happen, sometimes they come in and take too much. I've seen situations with clients where they give access and then they say, oops, oh, we take too much. We take 2 months out. I don't know what's happening. Never. I am a strong believer of not giving people access to your money like that. I don't have anybody in my in my piggy bank at all. So you can set up where the banks pay them on a monthly basis. So what you need to do is to figure out how much you can pay each month, right? And the number of payments you will make. So if you say this is my bill is $1,000, I'm going to pay it off in 12 months. This is how much I have to pay each month, and then set it up. So initiate that bill pay yourself, and your bank will send funds on your behalf. Now, let's learn the rules. When it comes to credit, so we talk about the budget, we talk about as a foundation, we talk about debt, how to get out of debt, what we need to think about when in debt, how to restructure it. Now let's talk about or learn the rules of credit. And I love this quote by Mark Twain. The secret of getting ahead is getting started, right? We cannot complain, or we can. My little guy complain all the time. We can complain, but the thing is, we cannot just get out of our situation. We gotta get started. We gotta make a move. We gotta make a decision. We gotta take action to change our position from what it is that we are in or we don't like, right? So credit, understanding the terms, understanding what it's all about. Credit is a big topic. A lot of people come to me to talk about credit. We want to know how to raise the score, right? Right away. What is it I need to do? What are the quick fixes that I need to take right now or I can do right now to raise my score? It's a slow game. Honestly, it is a slow game. Yes, there's like tips and tricks here and there, but that's not how credit works. You need to understand the rules if you're going to win. Remember, I mentioned that earlier on. You need to understand the rules if you're going to win. So, what is credit? Let's start there. Credit is how well you manage your debt. Yeah, it is. It or another way of saying it indicate how well you use other people's money. So if you're one of those individuals that borrow money from your family all the time and that you never pay them back, right? So when they see you, they're rolling their eyes like, here she come again, or they run and hide. That's not good. That is not good, right? We need to be responsible when we borrow money from people. So your credit measure how well or is how well you pay back your debt. Your ability to manage your credit is reflected in your score. It is a computer generated number. It's an algorithm, right? Do a whole bunch of stuff. And that calculate the chances that you will pay back a debt. So what are the likelihood that this person, based on their history, will pay back their debt, pay back what's owed? How do they get all this information anyway to make this calculation? First of all the individuals, all the creditors, all the companies in which you borrowed money from. Yes, they are telling your business. They're letting the bureaus know, hey, this person borrowed the money from me. They're telling the date it was borrowed. They're going to say if you're ever late, they're going to say the amount you borrowed, everything about it. They're going to have all that information. They know you. They know you financially anyway, the financial report of you. And they're going to report that to the credit bureau. So all that information that's collected so if you ever rent furniture, credit cards, student loan, personal loan, all that information, your bank account, all that information is going to be reported to the credit bureau. And that's your credit history. That's what makes up your credit history. Hence your history of your payments. And then, that create the report. Now, the lower the score, the higher the risk. Meaning that if you're that cousin that borrowed once or twice and you didn't pay it back, likelihood they're gonna go back and borrow the third time, you're not gonna get it unless they're gonna know it, unless your family is very nice and say, you know what, we just give you the money. They're just gonna cut their losses. They know you're not gonna pay it back, they're gonna cut their losses. Financial institution is not like that. They're not family, right? They're not gonna cut their losses. They're gonna list you or label you as high risk. You're gonna be paying really high interest if you want to borrow money in the future. So you are considered high risk of not paying your debt. And the higher risk is, or the risk, higher of a risk you are, the possibility exists that you might file for bankruptcy. So what is a bankruptcy radar here for you? Credit score can open doors of opportunity. It really can, like a job, home ownership, renting an apartment, or borrowing money. When we talk about the interest rate, so you really want to shoot for having a high credit score. So the higher the score, the better opportunities you have for getting approval and getting better interest rate. I have a friend who in college just, you know, you have a bunch of girlfriends and everybody have their own thing. Well, I was the business person. I was the one who was talking about credit and money from all those years ago. And so, oh, Petra, it's gonna be okay. And then when she went to buy a car, she could not buy a car, right? The only car she could have gotten, and this was back in the early 2000s, so it was those cars with the wind-up windows. You had to crank it up, right? Because she couldn't get an automatic car. The automatic windows was a thing back then. That was a feature. Now it's like it's come standard. That wasn't standard back then in vehicles. So she had to get the one that she had to wind up while all of us had our automatic window. Also, when she went to get an apartment, her mom had to co-sign for her. In almost everything that she had to do financially, she had to get a co-signer. Now, with that said, please do not co-sign. That's not something you should not be taking. Like I advise people, do not co-sign because the bank is saying when you co-sign, we do not trust you. We do not trust this person that they're going to pay us back, right? So you need to get somebody who is trustworthy, who we can go after in case this debt is defaulted by you. So if the bank don't trust them, think about it. Can you trust them to pay them back? right? Yes, life can happen and there can be a situation, but for the most part, I really want you to think twice, thrice, triple, four times. Think about it really hard before co-signing because basically by you signing, you're saying, I'm responsible for this debt. And they can sue you and they can put liens on your pay, garnish your paycheck. They can put liens on you for that money. So think about that. You are like the borrower as a co-signer. So yes, let's get back to this credit score. So a credit score can open doors for you, but it can also be difficult if you have a low credit score. It gives you access to better interest rates, more negotiating power. This is if you have a good score, and the ability to shop for better deals or help you avoid putting down big security deposit. Once again, my friend had to get her mom to co-sign for her, and she had to put down like 3 months deposit. It was crazy. While I, on the other end, I negotiated because I just left college. I had my job. I was in my job for 6 months. I was traveling back and forth to Bridgeport, from Bridgeport to Hartford, and that was commute was rough every morning. I was trying my best to find an apartment, after work. And once I finally found my apartment, I was like, look, can I only pay you? I would put a 1 month deposit, and I think that was it. So he was asking for 2 months deposit, first and last, and then the first month's rent. And I only put down 1 month deposit, and I did not think, no, sorry, I only paid the first month. I put a 1 month deposit. That was it, and he waived the first month rent or something like that. I got a really good deal, so I didn't have to start paying money until like the second month, really. So, and because I had really good credit, so even though I didn't have much money, I really took care of my credit because I knew of the power that he can hold when it comes to negotiating and the opportunities that he can provide for me. Now, let me ask you this question here. Which of the following information can be found in your credit report? Does anyone want to answer in the chat? Which of the following information can be found on your credit report? In your credit history report. Okay. All right. If you said D, the answer is D. All the above, your bill payment history, your loans, your debt, everything is reflected on your credit report. I told you they are telling your business to the credit bureau. They're telling all about it. All right. And I should tell the big three. The big three are TransUnion, Equifax, and Experian. Those are the credit bureaus. That's the information. So your creditors report all that information to the credit bureaus, and these are the credit bureaus. Now, some credit bureaus might have different information, or your score might be different from each of them based on what's reported. That's because all creditors do not report to all three of them. Some do, or most do, but some probably only report to TransUnion on Equifax or just Experian. So there might be a slight difference in score or slight difference in information that's reported to each, but either way, these are the big three. Credit range. I want to talk about, there's more, but we're going to talk about two credit scoring system, the FICO and the Vantage score. Now, FICO, Fair Isaac Corporation, and the Vantage score, most lenders, most creditor look at the FICO. So we're going to focus more on the FICO in this workshop, but I just want to let them know there are two that most people are aware of, are the most popular ones. The score, good, are poor, and very good, fair, bad. We go from 300 to 850. Once you hit the 740, you're pretty good. You're in a very good standing right there. 300, we need to do some work. We need to do a lot of work. So this is the scoring system. And for the FICO, 300, 850, once again, but it has different ranges, as you can see, of what is considered poor, fair, good, or excellent. So as we continue this presentation, remember, I'm focusing more on the FICO score. Most people think that TransUnion, Equifax, and Experian give their FICO number or give them the credit. That number is not. TransUnion, Equifax, Experian report the information. That information is then taken by these score agencies, FICO and Vantage Score, and then from the information gathered from your credit report, they tabulate or they put together in the algorithms and create the score for you. So there's another layer there. TransUnion do not give you a score. The information that TransUnion have help create the score. Now, with a FICO score, there are five parts to it that you need to understand. I keep getting these reactions. I'm sorry, guys. I just keep seeing these thumbs up and all these things on my, and I do not know where these reactions. I do not know where they're coming from. Maybe Ray
Mm.
can help me.
Petra, I do have a question.
Yes.
So I know obviously there are like the big three you talked about those credit units, but are there any more aside from TransUnion, Equifax, and like I've never heard of any others. So I'm just curious.
Well, no, those are the really big three that people focus on. And even when consumer finance, CFPB and everything, those are what they're going to refer to. And I did research that once actually, I was like, what are the others? So what it is that there's other scoring agencies, like we have FICO and Advantage Score. There's other scoring agencies for different things, but in terms of the reporting agencies that creditors report to, they stick to those three. But that's a good question. I'm going to look into that again because that was something I was very curious about too. And I keep looking because I've heard, especially when I go to webinar seminars and conferences and stuff like that, people say the big three. But I know there's other people that do the scoring or come up with different score system or metrics. But we focus on the FICO and sometimes the Vantage score. Make
Okay,
sense?
thank you.
But yes, those are the big three. That's what people rely on. And that's who they talk to. And the data collected usually Experian, especially Experian is branching out to doing a lot of things now. With Experian, gotta get an Experian app and all this kind of stuff. Those are the ones they lean on for your information. Thanks for asking.
Yep, thanks.
All right, so when it comes to the score, they're focused in five areas. As you can see, payment history, amount owed, length of the history, the new credit accounts, and the type of credit. And we're going to break each one of these down. So let's start with the payment history. There we go. Let's start with payment history. Payment history is 35% off your score. That is the biggest portion. It is 35% off your score. That means it has the biggest impact on your credit. So there's a lot of room and potential to increase your score in this area, right? So what does that mean? Pay your bills on time. I know life happens to us, but we need to try our best to pay our bills on time and be mindful again of that due date is time zone Pacific. Remember that, right? So what can we do? Pull your credit report. Pull it. Let's start with the low-hanging fruits. Pull it. Check for accuracy. According to the FTC, 1 in 5 people have errors on their credit report. 1 in 5 people, right? So make sure everything is updated and accurate and check accuracy in all areas as well. So the FTC is the organization, for those who don't know, that focus on consumer protection, meaning that it makes sure there's no unfair deceptive practice going on. It just protects us as the consumers, make sure look what all those creditors are doing and their agencies. So if you ever, and they kind of set the rules as they set the rules as well. They set the rules as well. So they say 1 in 5 people have errors according to them. So if they say it's true, they want that collects all the data. So check your report for accuracy. Now, activities in the most recent 12 months have the biggest impact. So yes, they do look at your whole history. They do look at your whole report. They do look at 4 years and 5 years and 6 years. But really, the first 12 months, the most recent 12 months, not calendar year, but the recent 12 months have the biggest impact. And the second biggest impact is 24 months. So check on that, right? And negative credit history falls off the report after 7 years. If you see arrows, going back to the arrows, if you see arrows on your report, there's different ways and different letters, templates available out there. I would advise you to go to consumerfinance.gov, which is CFPB, which again is a regulatory agency on the federal level, and they have different kind of templates for different situations. Identity theft, which also goes to the FTC, by the way, if you have identity theft problem. So you can find a lot of different templates and information that's available for you there. It's a really good resource for you. So when I'm helping some of my clients and to help them go through collection process and asking for information, they have wonderful templates there for that information as well. Okay, sorry about that. The next percentage, the next big portion is the amount owed. That is 30%, often referred to as the credit utilization, which is saying how much of your available credit have you used? That's what it's saying in simple terms. How much of your available credit have you used? Credit utilization looks at how well you use your credit. Your credit score takes into account the utilization for each credit card. And if you know that, total balance versus the whole limit of all of them. So I don't know if you know that. Remember, um, remember we were talking about the statement date and how important the statement date is, right? The statement date is the day your billing statement is prepared. So try to pay down a good amount of your card or that in the situation you're talking about credit card. So because you're shooting for 30% utilization. Matter of fact, just think of 30% as your max. Just think of it as your max. And some people ask me, is it okay to close the card? It depends. It depends on utilization. Usually if it's, because credit history, usually because of credit history is part of the percentage that make up your score as well. I would say if it's your oldest card, I wouldn't close that, but it all depends on your situation. It's a case by case basis. Now, when you're trying to figure out your utilization rates, you need to look at certain things. List all your credit cards. That's what I need to do. List all your credit cards, add up your credit limit, and add up your current balance. And then divide your balance by your credit limit and multiply that by 100. What does that look like? I give an example here. So say your balance is $2,500, divide by 10,000, right? Just for simple math for my sake, right? Equal 0.25, so times 100, I give it 25%. So right now I'm using utilization of 25%. Remember, they want to see 30% max. So if you're below the utilization rate of 30%, you're good. Now, say that you want to close a card. Figure out what utilization will be if you close that card. So take that card out of the equation. Will you still be below the utilization or it will be above? Will that make your utilization rate higher or lower? If it makes it higher, I will stay there, especially if you have big purchases you're going to make. So before you make any big decisions, figure out your credit limit or your percentage. The next portion is your credit inquiry. Now, this is 10%. Remember, we're going through the 5 categories that impacts your credit score. Just to remind you, your credit inquiry. Credit inquiries make up 10% of your score. It can negatively affect your score, right? Anytime you apply for credit, the company you're applying to will check your credit because that's what they ask you, a social security number. They can check your credit. Why does this matter? When you check your credit with your permission, or when they check your credit with your permission, meaning that you gave them your social security number, it tells the credit reporting company that you're trying to open a new account or get new loans or a new expense that will cost you that will cost you monthly. So you're gonna be paying a monthly bill. That's what they're thinking. That's what the machine thinking, numbers thinking, who's thinking, that's what they're thinking. Or that's the perception that's given. This means that there's a potential for you to get yourself in financial trouble and increase your debt. So credit inquiries can negatively affect your score for up to 12 months and stay on your credit report for 2 years. Now, there are 2 types of inquiries I want to talk to you about. There's a soft credit inquiry, and there's a hard credit inquiry. Soft credit inquiry does not impact your score, and you are not required, does not require your permission. So you know how those credit card bills you get in the mail, they're pre-qualified credit cards that you get in the mail. Those are from a soft inquiry, right? They look up your credit, they get a little glimpse, a partial glimpse of what's going on with you to see if you're the basic credit worthiness. And then from that information, they send you potential pre-qualifying credit cards. Now, a hard inquiry requires your permission. It requires your permission, impacts your credit score, and asks for your social security number. Your length. Now we're going to talk about your length of credits. This is 15% of your credit history. Only considers the time. This only considers the time. It takes into account your oldest account and the average age of your account. It does not take into account your payment behavior. That's your payment history. That's the 35% we're talking about. Doesn't take into account delinquency or collections. That's your payment history. That's what that affects. The length of history, the 15% only considers the length of time of the account. Takes into account the account, oldest account and the average age of your open and close accounts. So that's what I'm saying. If you're going to close something, think about the age of that account, because that counts toward 15% of your score. See, the more you know, the more informed you can make. If you know the rules, then you can make more informed decisions about your money. Now, managing your credit mix. Credit mix show lenders you're responsible and you can manage different types of debt. So if you have a credit card, now I'm not saying to go out and get a whole bunch of different kind of debt. No, that's not it. As life go on, you'll get the mix that you need. Scoring models they just like to see that you have a good mix of credit available to you. So student loans, car note, mortgage, personal loan, credit cards, just show that you can manage and handle different types of debt, a good mix of it. There are two types of credit. There are revolving credit and installment credit. Revolving credit, these are your credit cards, meaning that you pay it off and it's available to you again. Just keep going round and round and round like a merry-go-round. Installment credit or installment loans are talking about your auto loans, your mortgage. What else out there? Maybe your personal loans, right? So they have a fixed payment over a period of time. So if you have a 5-year card note, after that 5 years, or if you pay it off early, that's it. It's done. You zero it out. You're good to go. And yes, you can buy another car, but that's it. We're good. We're good to go. Whereas the credit card can use it and infinity and beyond. For those of you who like Disney. So understand that. I want you to understand that under that credit is an IOU. It is. You are borrowing from your future. So if you keep using your credit cards, let's stick with the credit cards. If you keep using the credit cards or taking out loans for different things, know that you're borrowing from that paycheck, the future paycheck that you haven't had yet. So if you have to borrow money now to cover your expenses, when you get your paycheck, are you gonna have enough money to cover your expense then? So really think about it. Do not put so many things against your paycheck that you're not able to cover your basic necessities, your basic everyday needs, or your everyday bills, or your monthly bills, I should say. Now, we need to set you up for success, right? We talk about debt, we talk about budget a little bit. That's a starting point. We talk about debt, understanding how that works and that robs you of your income, and how we need to put a plan in place to take care of that debt. And it's a part of the financial picture, but not the whole part. It's a goal to be debt free, not the whole part. And then your credit, understanding how credit works, the 5 components of credit, the different percentage, and what areas that we definitely need to work on, and those low-hanging fruits like utilization and the mix, we can help boost you up a little bit. So now we need to set ourselves up for success once we find out all this information. How do we do that? We got to make sure that we have the savings in place. We spoke about that briefly as you're going through the presentation, saying that, debt-free plus no savings equal having debt. because we need to have an emergency fund. So if you don't have the emergency fund fully funded, you know, put it as an expense in your budget. It's a line item that you got to pay yourself every month. It is very important. I know people say that, pay myself every month, but just like if you say you got to pay your water bill or pay your car note, pay yourself $50 every month and put it into a separate bank account, right? Open up a high yield savings account and put it in there so at least the pennies can get more than one penny. Because in the regular bank, it's getting a penny, a piece of a penny for penny. It's getting like basically nothing. So a high yield savings account is probably a better option for you. And it's not so easily accessible, but not as easily accessible where you can just go in and take it out if you see it. Separate, as I said, separate your savings account from your checking and build up your emergency. Usually 3 to 6 months is a good starting point. If it's too much for you to think about, don't think about the 6 months. Just start with three. Or start with 500. Just start somewhere to build up that savings account. Um, and if some of us like say, how can we get more money? How can we bring in things start at home? What do you see that you can sell? What do you see, all that unexpected money that you're getting for the holidays? Hopefully you get some, cross your fingers, put it towards your savings, build that up, pay off your debts. We talk about the avalanche and the snowball method. Come with a plan to pay it off. Decide today which one you're going to use if you have a lot of debt, or if you just want to reduce the amount of debt that you have so you can get more of your paycheck back so you can do more things that you enjoy, right? Find ways to generate that income to pay off the debt faster. What skills do you have? What can you do for others, right? Find ways to do, how creative are you? Think about it. Maybe go on a rice and beans diet. Don't do that. Don't over sacrifice. You don't have to over sacrifice, but come up with a way to figure out what's your needs and what's your wants. Really figure that out. And it's a good thing to do, especially when you're rebuilding your financial life or trying to change your financial story, is figure out what your ramen noodle budget is. In college, a lot of us, I know I ate some ramen noodles because things were tight. So figure out what that bare minimum budget is, bare bone budget. And if you know that number, then you can see, okay, if this is my bare bone budget and I'm spending, if my bare bone budget is $2,500 a month and I'm spending $5,000 a month, what can I do without so I can be closer to my bare bone budget, but still have a little fun? Because we're human beings, we still need to socialize and have fun, but do it in a way that you're not hurting your future self. I love this quote by Oprah. Said, we can't become what we need to be by remaining what we are. If we want a change, if we want something different, we got to do something different. We cannot still expect to keep doing all the things that we enjoy or we consider wonderful and be have a house of a financial mess or be in a financial mess, as they would say. We need to do something different. What are you willing to give up temporarily just to get to where you are? What are you willing to change? What habits are you willing to get to say no more to? Or what new habits are you willing to adapt or incorporate or build so that you can get the life that you want? A good book that I read, and I said I'm going to read it again because it's just a fantastic book, is Atomic Habits by James Clear, I believe. And if you can read that book, it's a good starting point. I really highly recommend that book. I'm not getting any money. He doesn't know who I am, but it is a great book for anyone who's just looking to understand habits, how to change them, how to implement them, and get to the next level. Are there any questions? Well, thank you, Ray. I'm turning it back over to you.
If you
I'm so
have any
glad that you guys
questions,
were able to be here today,
thank you so much, Petra.
and I will stop
All right.
sharing.
And you have a good rest of your day. Happy Monday.
Thank you, thank you. And you can always reach me, I should say, you can always reach me at brownfinancialsolutions.com, or you can follow me on social at AlletMoney365 or Brown Financial Solutions on Instagram and Facebook. So thank you, Hector, for having me. Thank you, Ray, for having me. It was a pleasure to be here.
All right. Thank you so much.